Hi, everyone. I'm Mike Bassito with IM Global Partner. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. This month's video update is going to be short but sweet, as we'll be hearing, as always, from Andrew Beer, co-founder of DBI and co-portfolio manager of DBMF. We'll be touching on macro, performance, positioning, and other interesting points after an excellent month for the strategy. Along those lines, we believe that 60/40 is badly in need of a reboot and update, and that's exactly what we're seeking to change with DBMF. We hope that you feel that we're delivering. With that, I hand it off to you, Mr. Beer.
Thanks, Mike. So September was an important month for DBMF, more reminiscent of 2022 than the first 8 months of this year. We were up 4.6% net on a price basis and 4.6% net on an NAV basis, ahead of both the SocGen CTA index, here and after the hedge fund index, which, as you all know, is an index of 20 leading managed futures hedge funds, and the Morningstar US Trend Systematic category, here and after the Morningstar category. So more importantly, those gains were delivered in a month when pretty much everything else went down, but let's come back to that in a minute. On the macro front, last month we talked about how confused strategists have been by the economy. As the consensus has snapped back and forth, from taper to sticky inflation to recession by June to higher for longer, markets have been whipsawing, which has not been great for the managed futures space. Today, there's a dawning realization that inflation might be higher forever. That is, the structural tailwinds, like globalization, might simply have run out of steam. Fiscal rectitude seems like a quaint, old-fashioned concept. So this new world order might have higher inflation for years, and with it, stocks and bonds moving in tandem. That is a huge problem for trillions of dollars of model portfolios. When stocks and bonds are positively correlated, the volatility of a typical balanced portfolio jumps by around 25%. So clients expecting a smooth train ride might be strapped into a scary roller coaster, a rude awakening, to say the least. On the positioning front, the core positions look similar to a month ago, in part because, well, most are working. We are short Treasury futures, a profitable position as rates keep pushing higher. We're long crude, another important driver of profits last month as oil jumped 9%. We are long the euro and short the yen, essentially a bet that Europe will keep hiking, while Japan will not, a trade that helped more in August than September. We're modestly long equities, but these positions keep rotating around and have not been driving recent returns. Finally, we're short gold, which is a great example of a traditional portfolio hedge that simply isn't working these days. On to the next slide. If you've watched any of our webinars, you might remember a slide titled Beacon of Green in a Sea of Red. It's a metaphor we coined about managed futures, that in a year like 2020, the strategy gained around 20% when pretty much everything else was going down. From a portfolio perspective, we think this is a wonderful quality. The potential for gains when other forms of diversification simply aren't working. So here's that same chart, but zeroing in on September. DBMF in the managed futures space posted strong gains, while stocks and bonds and tips and gold and REITs and liquid versions of hedge funds all declined. Clearly, 1 month does not a year make, but we think this chart clearly underscores why we think managed futures should be a strategic allocation alongside stocks and bonds. We've talked a lot about how in this brave new world, model portfolios need a third leg of the asset allocation stool, something that is not correlated to either stocks or bonds. And with that set up, let's jump to the next slide. So here's our usual slide on performance of DBMF since inception versus the S&P 500 and Bloomberg Ag. Since launch in 2019, we've delivered more than 10% per annum of alpha relative to the S&P 500. And DBMF has returned 51% cumulatively when bonds have lost money. So virtually every dollar of returns generated added value to a portfolio. From the perspective of a model allocator, it really shouldn't be a question of whether a strategy like this goes into a diversified portfolio, but rather how much. Of course, I should be clear by now, alpha is a lumpy bugger. No one on planet Earth has figured out how to consistently time managed futures any more so than timing equity markets. So our strong recommendation is to make the strategy a long-term strategic allocation and let it do what it's supposed to do. Next slide, please. Which leads to our next chart. Our performance versus the hedge fund index and Morningstar category. We are pleased to report that DBMF has outperformed both since inception with a correlation of around 0.9. As I think everyone listening to this call will know by now, We are huge believers in the diversification benefits of the space overall, and are simply trying to find what we believe is the most straightforward and efficient way to get exposure to the space. Last month we briefly talked about a paper we published in Institutional Investor. The title is, quote, "Why Managed Futures Funds Are Ripe for Replication," end quote. This created something of a stir in the industry because it sounds too simple. How could you possibly replicate something as complicated as the space with only 4 big, obvious, liquid futures contracts? So I don't want to rehash the discussion here, but rather would encourage you to Google the article if you want to understand how and why replication works as well as it does, and why the simplicity of replication and complexity of single manager funds can and should coexist. Next slide, please. So finally, here's our standard chart on volatility adjusted positioning. As a reminder, we show it this way since it could be confusing when looking at notional position sizes. What looks like a big position in something like the 2-year Treasury might be less risky than a small position in crude oil. So it helps to make the exposures more apples to apples. This month, we're showing it relative to June 30th to underscore how dynamic the portfolio has been over the summer. To start from the left, we flipped from short to long crude oil and from long to short gold. We've maintained our long position in the euro and short position in the yen. We're short across the Treasury curve, whereas after the SVB unwinds, we flipped for a period to long the 10-year. And lastly, we're modestly long equities and have unwound a spread trade that the S&P would outperform non-US developed stocks and EM. And with that, I'll hand the baton back to Mike.
Thanks, Andrew. So in closing, let's showcase the since inception performance of DBMF versus the index in the category. Long-term outperformance, which is what we focus on as long-term allocators and investors, against the index has broadened since our last update, beating the SocGen CTA index by over 230 basis points annualized since inception. Outperformance against the Morningstar average has also expanded over 435 basis points annualized since inception. We believe these results are convincing, and we hope that you do too. A combination of index plus replication, with fee reduction being the purest form of alpha, are the key characteristics of what makes DBMF unique and compelling. So closing here by saying thanks to all of our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out or send us an email at team@imgpfunds.com. Until next time, from DBI and from iMGP, thanks for spending time with us.